Hello and welcome everyone. Happy Friday. Hopefully everyone is having a lovely week, has had a lovely week, and is ready for an awesome weekend. Today is going to be a little bit different of a webinar. I know I've probably said this before, but this may be a bit shorter of a webinar, but interesting nonetheless, because this week saw a very important day in US events. We had the US presidential election happen on Tuesday, and it is now Friday, November 6th, and we are still counting. So the election is not decided yet, but what is decided is how the market would react up to the election. So that is what I want to talk about with you all today. And before I go into this presentation, I want to say this. I'm not here to talk politics. I'm here to talk stocks. So I will not be talking about the outcomes of the election, trying to speculate about the election or anything like that. I am here to share with you guys numbers and share with you guys how the stock market reacts regardless of the election. Because one thing is for sure, the market doesn't like uncertainty. The market doesn't like chance. They like knowing what's happening. So when the market doesn't know what's happening, aka an election, you never really know how the market can react, but you know that it's going to be a little bit more crazy than usual. So that's what we're here to talk about today. We're going to talk about how the market has reacted so far in the past week. We're going to compare this year to other election years and see if we can find a trend with the stocks to see if there is a difference in how the market responds or how the market reacts before the election and after the election. And then also we're going to look at volatility and see how volatility impacts the market. So without any further ado, let us get to it. So what I want to start off with today is I want to share this chart. So what I've done is I've gone back to the previous 10 elections. So this is 2020. I've gone back to 2016, 2012, 8, 2004, 2000, all the way back to 1980. And I've gone through and taken the returns. So for example, if the stock market went from $100 to $105, that's 5%. So I've looked at the percent returns, so not the dollar amount, the percent that the stocks have gone up or down, to see if we can find a trend, to see does the market get happy before the election, do stocks go up on average, or does nothing happen? So that's what we're going to talk about. Before I go anywhere, I do want to say hello to everyone that we have with us today. Siria, Chela, Emelida, Anna, Eddie, Maria, Elizabeth, Francia, Maria, Rick, Erika, Juan, Kira, she's somewhere over there, Vero, who else? WC, Biza, Alex, Pablo, Muffin, that is a funny name, Consuelo, Nancy, Jorge, Wendy, Alma, and Maida. Thank you all so much for being here today. Let's get to some fun information. So the first thing I want to do with you all is I want to look at this. So this is the raw data. This is what I used to actually make the chart I'm going to show you. So what we have here is this yellow column right here, and my mother, hello. This yellow column we have here is election day. This is going to be elections in the United States will happen usually the first week in November, and it falls on the first Tuesday. So election week or election day this year was Tuesday, November 3rd. So to try and get away from dates, I've labeled it as 0. So 0 is election day in every one of these years. And then the negative numbers are the days before the election. The positive numbers are the days after the election. And then to give us one number that we can look at to kind of get a general trend, I've also averaged all of these so we get the average number for each day. And that is what we're going to look at right now. So let's start off by looking at this. This is the chart for the stock market before the election, where on the far left we have 10 days before the election, and on the right we have 7 days after the election. And right here is 0. This is election day. And with the exclusion of 1 year in particular, this big gray line is 2008. We're going to ignore 2008 because the market was not the reason, or rather the election was not the reason that the market was all sorts of crazy. There was another small thing happening called the stock market crash, or rather the recession, however you want to put it. The market was not very happy. So because of that, we see that there's a lot of volatility. The stock market is going up and down very, very quickly. So I'm going to remove that so that we can see things a little bit clearer. I don't think I need to tell you that this is all over the place. There is the 0 line right here. That is 0%, and it jumps up and down pretty randomly, where this dark green line is the average. So if we were to take the average of all 10 elections, this is what the average would be. And then this blue line here is how the market has done every day this year up to the election. And now we are 3 days after the election. But there's nothing. There's literally nothing. There is no trend. There is no order. It is random because the market doesn't care. The market works off of dollars and cents, not off of votes or parties. So it really doesn't matter up to the election how it's going. The market is going to do its own thing regardless. But is that always true? Kind of. So first, let's look at this. The first thing I want to look at is this is all of the different elections. This is Democrat and Republican winners. But let's separate those. Let's see, maybe, is it because we're looking at maybe do Democrats have a better market reaction or do Republicans have a better market reaction? So let's take a look at that. Here we have the chart for the returns for Democratic presidential winners. So the Democrats won in 1992 and 1996, and then they won again 2008, 2012, and 2016 should not be Democrat. I apologize for that error. Let me just quickly remove that. Okay, so these were the 4 years in the past 10 that a Democratic candidate has won the election. And what we see is it's basically jumping around 0 the entire time, where if we expected to see the market performing well prior to an election or after an election, we would expect to see this be a very straight line above 0, where if the line was straight across 2 here, it would be that the market went up by 2% every day. But that's not what happened. The market is pretty volatile, but jumping all around 0. So we tend to be around 0 the entire time. A bit above, a bit below, but never very far from that number. Besides 2008, where we already talked about, there was a little bit more going on there than just an election year. So how about Republican? Do we find something in the years that Republicans won? Not really. Again, everything here is about as 0 as we can get when we look at over time. So again, while each year can be different, we don't see a trend towards one candidate or another, where if Democrats win, the market does better, or Republicans win, the market does better. The market just does. So why have I just gone through all this? Is there nothing we can kind of forecast when it comes to an election year and to figuring out how the market handles an election? Well, not by looking at this, but there is one other thing that we can look at, which is there's a president, yes, but there's also the House, which is the House of Representatives, and then we have the Senate. And both the House and the Senate make up Congress. So how does the market handle, because we've talked about the president being Democrat or Republican, there's not much of a difference as far as the market's concerned, but there is when it comes to the overall politics of things. It matters not who the president is, but does the president agree with Congress? So that's what this chart shows here. This is something that I took from RBC Capital. They did a study where they looked at the average returns for the S&P 500 since 1933. And they found that stocks tend to go up more when a Republican is in office with a Republican House and Senate than they do when it's Democrats in full power. On the other side of that, when Democrats are in the presidency but don't have power in Congress, we find that the market does better than if only Democrats are in power. So that's something interesting, but again, I'm not here to talk politics, I'm just here to talk numbers. And the numbers don't lie. They are saying that when the entire political atmosphere is Republican, the stocks tend to perform much better. When it's all Democrats, it still performs well, but not as well. The best times in the market are when Democrats are in the presidency and Congress is split between Democrat and Republican. Go figure, when everyone's voice is heard, the market's pretty happy. So this is all returns. We're talking price here. Now, let's talk something else. Let's talk volatility, because volatility is where we'll really find the change. So we talked a little bit last week about volatility, or sorry, not last week, on Tuesday for the members webinar about volatility. And our gauge of volatility is the VIX, the CBOE index for volatility. Now, I don't think I need to tell you that volatility will go up when there's things in the world that are not certain, because investors want to be able to forecast things. We want to know what the weather is going to be tomorrow so that we can plan our vacation or plan our Saturday. So what happens if there's a storm coming, and the storm could come right over top of us, or it could get blown out to the ocean? Kind of messes up our weekend plans, right? Same thing happens with the stock market. Investors, they don't invest on what they thought made money or what they know made money yesterday. They invest on what they think will make them money tomorrow. So when they're forecasting, when the ability to know what the weather is going to be tomorrow goes away, so does their confidence. Now, all of a sudden, investors are going to start to get worried. They're going to start to be a little bit more defensive, or they're going to start trading a little bit more all over the place. So that is where we see volatility start to go up, where we see more volatile times in the market when there's more uncertainty in the world. So what does that mean for the election? Because the election is a very large uncertainty. It's something that, unless you have some incredible power, you're not going to be able to know. So that's where we have to look at the VIX. And thankfully, someone's already done that for us. So let's look exactly at that. What we have here, I apologize if it's a little bit blurry, but I'll go through it. So this red line in the middle is election day. To the right is 2 months. To the left is 2 months. Now, what we have is the purple line is the volatility of the S&P 500 as represented by the VIX. 15 is what we consider to be an average market. Anything above 15 is considered to be volatile. Anything below 15 is considered to be less volatile. And we have the price here. This black line is the price of SPY as the election comes and goes. What we see is pretty normal trading in the from 2 months to 1 month before the election. However, after the election cycle begins, once we reach that 1 month period before the election, that's when volatility tends to spike. So we see here that volatility in the month prior to the election goes up to an average of about 18. Now, this study that I'm showing here was done in 2017. So it doesn't include what's happened this year with the market, where volatility 15 is a dream that is completely not going to happen this year. Our volatility has been at the lowest 15 in February, but since then has failed to get below 20. So we're already above this purple line. So what does that mean for our volatility? Does that mean that this doesn't hold true? Because look what happens after the election. Volatility in the days after the election goes back down and doesn't just go back to normal at 15. It tends to dip even lower in the 2 months between election and inauguration. So while the new incoming president is decided in November, there's a 2-month period before the new president takes power that the old president still is in control and begins handing off a lot of their job to the new incoming group. So during that period of time, we see the stock market start to get back to normal, where it's not even just normal, it's stable. Things calm down. The weather becomes a little bit more predictable because now we know not just where we are, who's the president today, but we know who the president's going to be in 2 months. So forecasting in an economic sense becomes a lot easier. So with all of this being said, what does that mean for this year? Because again, we've already looked here. This dark blue line, the super fat blue line, is this year. And this year is not unlike any other year. It's a crazy election, but it doesn't mean it's a crazy market. The market is about on par with how it's been in previous years. But the VIX says otherwise. While the daily returns, yes, they're within what we expect to see, the volatility is not. So let's go take a look at that together. I want to pull up, not FinViz, the other FIN. Let's look up here, VIX. And let's go full screen. And we want 2 months prior to the election. So we're going to go, oh, hey, it's almost like it predicted what I wanted. And now we're going to have two things here. We're going to have the 252 moving average, which is our 1 year moving average. And then we have our 50, which is just a bit over 2 months. So what we see in purple here is the 2 month, quote unquote, 2 month. And what we see in red is the 1 year moving averages. On the far right, this is the volatility of this current day, 25. Remember, 15 is where we say that's stable, that's normal, not volatile. This is a little bit crazier. So we're above 15, we're up at 25. So what does that mean though for the past few weeks? Because let's look back here. We see that we started at normal, 15 normal, and then it goes up on average about 2 points over, or about, because I'm bad at math, give me one moment, goes up about 13% over its normal value. So 15 is normal. We're going to say it goes up to about 17 to 18. So that's anywhere from 13 to 15% higher in the month prior to the election. So what does it do? What has it done this year? Well, we're going to take our average, because again, average this year is not very average. So we're going to say our average is, let's use 28, because the simple moving average for both the 50-day and the 1 year are kind of in agreement here, where they're about 28 to 28.5. So we're going to use 28 as our baseline. We see in the month prior to the election, things were pretty calm. And then in the 2 weeks prior to the election, we went up to about 40. So we went from 25, which was our average, to about 40. A percent change of about 30%. So well over our 15 to 20% range that we typically have. Now, that doesn't mean that what we're looking at is rare or different. It's just more volatile. But we still see the same kind of pattern. We have here flat, 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 flat month before this big spike, and then a dip down below the average. Flat, 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 spike before the election, dip below the average. So while this year is definitely not a normal election year with normal circumstances, the market doesn't care. This is another election period where it will have its normal volatility prior to the election, and then going into the election, volatility will spike. And then as the election becomes decided and things start to calm down again, the market dips below its average once again. So I wanted to really illustrate this to show that elections are something that happens every 4 years. And the market follows a cycle. The election cycle is no different, where it will react to the market or to the election cycle in a certain way. It's not dependent on if a Democrat or a Republican wins. It doesn't see red or blue. The market only sees green, dollars and cents. So the market is going to follow the economics of this all. The only thing that the market will react to in the election is the fact that right before the election, nobody knows what's going to happen. No one has a clue who's going to win. Well, they may have a clue, but no one knows what that means for the country. So as a result, uncertainty increases, confidence decreases, and volatility spikes. As the election passes, volatility doesn't just go back to normal, it dips below normal. And we go into a period of a little bit more calm as we know what the next 2 months may look like. Did we have some questions?
Lily was asking, was it not good this year?
Was it not good this year? The volatility definitely says that we had a very similar pattern, where we have this normal kind of spike that we would expect to see in an election, going from about last month in about 1 month ago to, election day right here. We see that the volatility skyrocketed about 15 points higher than its average. But as the election has passed, the volatility has returned. Remember, The red and the purple are our normal. The red is our 1 year average. The purple is our 50-day average. And we see now that our current value is well below both of those averages. So in this year, it wasn't really bad or good. It just was. It was another year in the market as far as it's concerned. When it comes to an election, it is. The market has had some very, very good days over the past week. And we see that by looking at the matrix, where last week, here, you know what? We're going to go look at the matrix. I can't do that on air. I'm going to bring it over here. Give me one moment as I log into the matrix. I may have helped create the matrix, but I still need to log in just like all of you.
You asking a question.
Okay. So here is the matrix. So based on your graph, if Democrats win with a divided Congress, it's good, right? Great question. Let's actually look at that, shall we? So right now we have, okay. I am going to now have to speculate. This is not 100% certain, but as far as the numbers are currently slated, we are looking to have a Democratic president, a Republican Senate, and a Democratic House. So a split Congress. So that would be this big blue column right here. Again, nothing is for certain yet. We're still waiting. But if things go as the odds currently say they will, we are looking to be in this middle blue column with a Democratic president and a split Congress, which is also the best performing market conditions, or rather the best returns that we could hope for as far as politics is concerned. Where again, Republicans controlling everything is 13% return. Democrat with a Republican Congress, 13% return. Democratic president with a split Congress, the best performing one of them all, at 14%. And yes, exactly. Nothing guarantees that the end results of the market conditions will follow history. And I think that this graph is a very good indication of that. Because again, if we knew exactly how the market would react depending on how things went, this graph would not look like this. It would look like a flat line at 2% or 3%, whatever the daily returns would be. Okay. Emily that has a question. Do you think it will be ready to go back to normal when we are uncertain, maybe until January, who will win and the COVID returns to closures? So I don't think we'll be back to a flat or a 15 volatility market for quite a while, simply because there's too much going on in the world. Because again, the market 15 is based on a stable economy, stable political climate, stable global climate, stable sector rotation, stable calendar rotation, and stable economic rotation. We don't have a lot of that right now. So because we have so many different things that are moving around, both domestically and internationally, and in the economy, both in the US and in the globe, it's very hard to say because we don't just go back to normal. Usually what will happen is when things take off, they'll dip back down, but they don't go back to normal. Like this graph shows, they will dip below average. They will go back down before they finally go back to normal. So that is why we need to look at things like the volatility, is because it will tell us when things start to go back to normal. Where if we see here, let's go back a little bit. Because we did have a period where we started to get back to normal. Right here in August, we had a nice little dip in the market where things started to go back to normal, But again, we've already said that our average this year for volatility is around 28. That puts us around this point right here, where this little dip that we saw through July, August, and into September was not a new normal. That was just the dip. And then it corrected back to normal before skyrocketing due to the election. And yes, as my mom is saying, this kind of is the new normal. Because for the next foreseeable future, this will be normal. Let's go back and look at 2008, because I think that we'll find something very interesting during that period. Let's look at how long it took before our volatility got back to normal, shall we? So again, we started off that year around 20. So still a little bit high, but not unreasonable. Back in April, before any of this craziness even began, April 2008 that is, we saw that we were down at our 15, 16. So, how long did it take to get back to 15? It took 2 years. So because of a recession in the economy, it took 2 years for our volatility to return back to what we consider to be normal. And that volatility works despite, just because volatility goes up doesn't mean the market's going down. Volatility could go up because the market is skyrocketing up. But again, that's like saying that it's beautiful outside, but there's storm clouds in the distance. There is uncertainty, but right now it's sunny. So that's why it's very important to learn how to trade in these different types of markets and these different types of economies, is because we can't wait for things to get back to normal before we start going back to our normal routine. We need to learn how to adapt to the current climate. That is why it's very important to learn and figure out how to find sense in this craziness. So that is what I really wanted to share with you all, is that right now, despite it being a crazy time in the world, the market doesn't really care. Yes, it had its usual election week spike, election month kind of volatility, but that's come and gone. And again, the market's not too worried about the whole news cycle and all of that. It doesn't follow red and blue, it follows green. So it's going to stick to that. Let's see here. Wendy is asking, cuando la volatilidad es baja, ¿podemos soltarte más la correa al perro? Okay, so, sí, pero estamos buscando para dos cosas, porque tenemos volatilidad, pero tenemos beta también. Y estas cosas están juntos, porque tenemos volatilidad para el mercado, pero tenemos beta para comparar una compañía como el mercado. So we have two things going on. We have volatility, which is the overall market, and then we have beta, which is how the market or how a stock compares to a market. So I actually had a great question from, who was it? It was Rosie, I believe, who asked about a stock where she was saying, how does volatility work with something like Tesla when I'm looking to set a trailing stop? And that's a great question, because to quickly recap, beta is, yes, it's volatility, but it's the volatility between a stock and the market, where the market is considered to be 1. So if it's a ratio between the company to the market, if our beta of our stock is 1, that means that for every 1% the market goes up, our stock will go up by 1% as well. If a beta is 2 for a stock, that means for every dollar the market goes up, our stock will go up too. But that also works in reverse, where if a stock goes down by 1%, if the market goes down by 1% with a beta of 2, a stock is going to go down by 2%. So what happens when the market is volatile for a stock that has a high beta? Well, that is where we get a case of a stock that the changes in the price are going to happen very, very quickly. 5% for a single company may seem like a lot, but for other companies, 5% in a single day is, par for the course. So let's really quickly go look at Tesla. Because Tesla's beta is almost at 2. So that means that the price of Tesla is going to change about double that of the market. So what does that mean for its volatility? Well, if we were to do some basic math, if the volatility of the market is 25, with a beta of 2, we could say the volatility of Tesla is about 50. So that is high. That is very, very high. So it goes to show that, bye mom, have a good one. So it goes to show that it's very important to be looking at not only the market and that's the market's volatility, but when volatility is high, realizing that if the market is changing price a lot, stocks will be changing a lot as well. So a stock with higher volatility compared to the market in a volatile market will be even more volatile. I know it's kind of a little bit redundant, but hopefully the point is clear that when it comes to trying to do something like setting a trailing stop, for example, if you're setting a trailing stop for a company, don't just look at the volatility of the market. Look at beta as well, because again, the volatility of the market is still going to be 1 when you compare it to, or when you look at it for beta. So if the market is going up by 1% and a beta of 2, your stock will go up 2%. But what if we're in a volatile market where the market can go up 4% in one day? Or what did the S&P 500 do earlier this week? Because if I recall correctly, it had a very good Tuesday. It went from 33.68 to 34.45. So, sorry, I'm just going to go do some math really quick. So we saw a percent change of of about 3% in the market in one day. Now, 3% with a beta of 2. That's 6%. So right there, we see a single stock with a beta of 2 when the market changes 3%, going up about 6% in a single day. Now, what if that was a stock that in a day that the market went down by 3%? The opposite's going to happen. Your stock is going to go down by 6% in a single day. So what happens if you set your trailing stop there? What happens if you set a 5% trailing stop? You're going to reach your trailing stop in a single day, which is kind of crazy, but it can happen. So that's why setting and changing your trailing stop is important, because 5% in a market with low volatility is a lot. 5% in a market with a lot of volatility, it's just another day in the office sometimes. But that's their game. You get to decide if you want to play that game. So that is the most important thing. Take beta and take the volatility. Use the two of them together. Oh, did she find a piece of plastic?
She did.
Come here. Say hello. This is Cleo. She's a little goofball. So, volatility and beta work together because when you have high beta and high volatility, that stock is going to change price very quickly. So, keep that in mind because setting a 10% trailing stop for a stock like that, if that's a level of risk you're okay with, will give you more opportunity where your price is not going to, you're not going to hit your trailing stop because you had a bad day or the market had a bad day. Because the next day it could go back up. It can correct. So it's all about risk. Not just how much risk there is in the market or how much risk there is between the market and the company, but how much risk you are okay with. If you are a little bit more adventurous and you want to be able to ride out the highs and the lows, you want, I want to see this through. You may set a 10% trailing stop. You can have one day that the stock goes down 5%, but the next day it may correct back up. That's great. Or if you don't want to have to worry about risk, you want to be much more secure, you can set a 5% trailing stop. Because then, if a stock has a bad day, you sell off. Sure, you may have, lost a little bit, but it saved you from having to worry about, oh, my stock went down 6%, is it going to go back up? So that's really what this all comes down to, is how you look at volatility and what your level of happiness is with that volatility. It's really up to you. So take all of this together. Put all of this together because the market does seem crazy right now because it is reacting to the election. But it's not reacting in a way that is rare or different. It's reacting basically how we expect it to, but with higher than average volatility. And if we look here at the matrix, let's compare it to last week. Last week, we had one sector above a total count of 15, and we had only 4 above 10. Compare that to this week, where we have 2 at 18, and we have 7 above 10. So, while we haven't had much change in terms of volatility, we have had changes in terms of strength, where everything has become much more stable. Looking at this table, one sector saw a large negative change, but all the other sectors except for, energy and staples, they had slightly went down, but massive changes of 8, 8, 4, 4, huge jumps in relative strength because the volatility has gone down. The overall market is more stable. Sectors have gained a lot more strength. So now we have a leading pack of sectors, not just one outperforming sector. We have our leaders and we have our laggards. But all of that is in this climate of a decreasing amount of volatility. So always be looking at this, because just because of the election doesn't mean that we're looking at unprecedented times. This is very, very normal. And the further we get away from the election, the more and more normal, whatever the new normal is going to be. So learn how to trade in the new normal. It's going to require you to adjust your trailing stops or adjust your level of risk, because the higher volatility means things will change price quicker. If you have a stock with a beta of above 1, your stock is going to change even more than the market does. For many of you, that may be a great opportunity because there's more money to be made. For others that are less adventurous, it's going to be a little bit more worrying because there's more chances for things to go up and down. But that's where you make your money work for you. You set your trailing stops to where you're comfortable, and from there, you follow it. Because I can't tell you what's going to happen tomorrow. I can't tell you what's going to happen on Monday. The market can't even tell you that right now. That is why volatility is high, is because we don't know what is coming in the future. What we do know is that this election is not some rare occasion that will never happen again in 50 million years. This is another election in the United States, and the market is reacting just like it usually does. So that's what I wanted to share with you all today. I wanted to share how volatility is put into practice, how it's kind of seen through an election, that while we'll have some good days and some bad days, they're not unexpected. The market doesn't care who wins. The market just cares that there is a winner and that after 2 months, the new winner takes over. But as we see here, if things go the way that they currently look, a Democratic president with a split Congress is about as good as you can expect for the market. So that is what we have to look forward to in the future. But for right now, volatility is going down, sectors are going up, and this past week we had 2 sectors go on buy signals. To figure out what those sectors were, or if you're interested to learn more, check out our newsletter on Monday where I talk a little bit more about the sectors, what sectors have emerged victorious through this past week, which ones show some signs of growth, and where the opportunities may be. Does anybody have any questions? Again, I said this would be a little bit shorter of a webinar, so we have some time if people have questions or anything that they want to talk about or anything. I am here to answer.
Someone's having internet problems.
Alrighty, if we don't have any questions, I'm gonna do my usual thing. You can always get in contact with us at, I cannot type and talk at the same time. You can always get in contact with us at support@sectorsmadesimple.com. That will be someone that is either me, Kira, Vero, someone that is involved with sectors will see this, and they will make sure, or I will usually be the one to respond, or it will get seen. Yes, Kira will respond to them as well, but it will be seen by one of our loving eyes. So get in contact with us, ask us your questions. If there's something you would love to learn more about, we're more than happy to help out and help teach you. So there is a question. Can we compare Tesla with the S&P 500? Sure, let's do that. So again, when we're looking at beta on FinViz will always be compared to the S&P 500. So what this is saying is Tesla, on average, will go up will change price 2 times more than the market will. Yes, I think it'd be very fun, Kike, to have a class on options. So I will definitely try and do that. Maybe not this upcoming Tuesday, maybe the Tuesday after. So let us go look at, I want to compare the market and, I apologize, the market and SPY. So Tesla and SPY. So let's go do that. We're going to do this. And this, again, is going to be the relative strength between the two. It's going to be the relative strength between Tesla compared to SPY. So right now we see that Tesla is currently outperforming SPY, but it's been kind of gradually decreasing. So SPY has been gaining a lot of stability as the volatility started to go down. However, we see here that Tesla kind of flatlined. Tesla had a period of time that the price didn't really do all that much. It stayed within about a 5% band for quite a while. And as a result, because SPY saw a massive uptick in price with swings well above 10%, it's not unreasonable that when Tesla is kind of staying still and SPY is all over the place, that's what you're going to see in the chart. So we see over time that Tesla is losing strength compared to SPY because, again, Tesla here has remained pretty flat, if not on a slight decline, while SPY has been on a slight incline, mostly picking up after the election, where it's taken off with a jump of about 10% in the past week alone. So right now we see that even though beta of 2 means that we would expect for Tesla to do twice as well as SPY, that's an average. And that's an average over the past 5 years. So when we look at 1 week in the course of 5 years, beta is going to be much less important, more so than the market conditions are. Where here we see a jump of 30% in a single week for SPY, while Tesla has remained pretty flat. However, earnings season has also come out, and that's why we see this slight downward trend right here, is because the earnings reports were nothing special. We saw in August a massive jump in price as their second quarter earnings destroyed estimates, and we saw that Tesla was announcing a 5-for-1 stock split. Because of these two large pieces of news, Tesla's price skyrocketed. So it's very important to keep in mind that right now Tesla has been very flat. And the reason we see the chart in this slow, gradual decline is because SPY is currently trending upward significantly, especially in the past week. And Consuelo is asking if the actual volatility is affecting the performance of Tesla. Yes. So again, volatility is based on the entire market. So while 80% of a stock's movement is due to its sector, there's about 20% or so that's due to the company. So while Tesla is not improving, it's not worsening, we still do expect for 80% of the movement of the price to be related to the market or to its sector. So volatility applies to that very heavily because it's all market capitalization weighted. The more your company is worth, the more important or the more value you have in the volatility. So for a company like Tesla that is worth billions of dollars, we expect to see it be worth a lot when it comes to evaluating the volatility of the market. However, again, beta is a more long-term thing. It does not change very quickly. It changes over months, if not years. VIX is a 30-day forecast. So it's looking at the next 30 days to say the volatility. So it's going to change much quicker on a daily or a weekly basis. So it's important to be looking at both because beta is going to give you that more long-term idea. Because again, we can look at stocks on a daily basis, but many of us don't trade daily. We trade weekly, bi-weekly, maybe even monthly. So looking at those more stable long-term investments is a good option, but a higher volatility market makes that a little bit trickier. So that's where going back to something like an ETF is a great choice because that will give you not just the one company, but lots of companies in a single sector. So you're buying that 80% movement, and that is going to be related to volatility because the entire market is related to volatility, but your piece of the pie is a lot bigger with an ETF than it is with a single company. Let's see. Yes, Sofía, por favor, envíame un email y puedo darte un código cupón para comprar eso. Alrighty. If there's no other questions, this is where I will leave it for today. Thank you all so much for joining us. I hope that everyone has enjoyed this presentation and has learned something new. Again, it's tricky to get to present something like this because I don't know what's going to happen. I wish I could tell you what's going to happen. All I can do is look at the market alongside all of you and say how all of these different pieces of information work together. Consuelo, sadly, that is a question that I cannot answer very easily. That requires a lot of knowledge beyond just an understanding of the company and its stock, because then we get into company valuations, and that is some crazy accounting and company valuation stuff that I sadly don't know enough about.
Do you have an explanation as to why INSP, a stock with bad fundamentals, would go so high?
Do I have an idea why INSP would go so high? Where is that?
Scroll up. Right there.
Let's take a look. So, Francia is asking about INSP. Most likely because they had a very good earnings report. If I had to guess, it would be because of that. They are in the healthcare sector, which has had an absolutely incredible week, and it's very likely that they beat out the estimates for their fundamentals by a high amount. So keep in mind that something like EPS quarter over quarter or anything like that is going to be related to a year over year basis. But it doesn't matter how the stock has done in years prior. Investors often will buy based on how it's doing right now. So we see that right now, institutions own 96.5% of this company. So it's very likely that because of its earnings report in early November, the stock took off. Tesla has done the same thing, where after earnings reports that are very, very optimistic, the price takes off. So it's not unreasonable to see a large change in price, but always when you see a change in price like that, check when the earnings reports come out, because oftentimes the reason for it is because the earnings outperformed what we would expect to see. Let's see. Let me see if I can find anything on. Okay. So, this is just looking at the earnings. Here we have the quarter 4 of last year and quarter 1 and 2 of this year. The circle, the clear circle, is what the earnings estimate was. So that's what the analysts and the people that look at stocks, they said, we think it's going to be this. So they beat out the estimate by double. Now, the estimate was not good. It was still, the earnings here, yes, it's double what the estimate was, but if you look, all of this is still a negative number. So it means that the company's fundamentals are not good, but they were twice as good, or half as bad, I guess is the right word. They're half as bad as what investors were thinking it was going to be. So yes, the fundamentals are not strong, but the value of the company was not based on strong fundamentals. It was based on how investors viewed the company. So because their earnings were double that were expected, yes, they still lost money. Yes, their EPS is still down this year, but it's better than what people were expecting. The same thing has happened for Tesla in the past, where if we look here, we see that when they beat earnings reports, the stock tends to go up by quite a bit. So it's very important to keep in mind when earnings reports come out and how investors view the company before and after that. Because if the company's earnings are much different than what analysts were expecting, be ready for the price of that stock to change, both for the better and for the worse. Alrighty, that is about all the time we have for today. Thank you all so much. Have a great weekend, and we'll see you all next week. Take care, everybody.